Good morning, everyone. Thank you for taking the time to join us for this update with John Moog, Portfolio Manager for the Pengana Global Small Companies Fund. My name's Brett Gearan and I work within the New South Wales distribution team. John is the CIO of Lizard Investors, a specialist firm with which we partnered to run the strategy. Lizard are based over in Chicago, which is a global hub for small cap investing. So having the opportunity 5.5 years ago to bring their knowledge and expertise of the global small space to Australian shores for Australian investors has been a great outcome and a very fruitful partnership. I'll pass over to John in a second where he will run through the strategy, but first he'll touch on the global smalls landscape and the opportunity set because it is a very vast universe. Now, we all understand the concept of diversification across asset class, but of equal importance is diversification within asset class. And we firmly believe that a dedicated global small cap exposure optimises the risk return outcome for investors within the global equities allocation of their portfolios. During the presentation, if you have any questions, please enter them in the Q&A box at the bottom of your screen, or potentially for some to the right of your screen, and we will get to as many questions as possible at the end of John's session. I'll now pass over. Thanks, John.
Great. Thanks so much, Brett, for the introduction, and thank you everyone for joining me today to chat about the Global Small Companies Fund. I look forward to chatting with all of you. Again, my name is John Moog. I'm the CIO and Portfolio Manager of the fund. The firm has been around for 10 years and the fund has been around for 5 years. So we've been doing this for a while. Today, I want to talk a little bit give you guys a little background on us, kind of our corporate overview of Lizard itself. For those of you who are familiar with the business and the fund, I'll do this reasonably briefly. I'll also touch on the global small company space, our investment strategy, spend a little more time on the current environment and what we're seeing. We think it's a pretty interesting and unique environment, especially with what we've been through over the last year as a society and as investors. I'll touch a little bit on our performance and how that's gone over the last year, and then we can finish up with how the fund is positioned and some case studies on individual stocks, and then hopefully get into some questions. So again, Lizard has been around since 2008. We launched our first fund January 1st, 2009. And we are, again, a dedicated global small companies fund firm. We focus, all of our investment offerings are really focused on what we consider the orphan universe of small global companies that are really under the institutional radar of many investors. Here, just taking a look at the team, myself and David Lee have been together since the inception of the firm. Lee Zell was the founder and who put this together back in 2008. The three of us worked together for quite a period of time. We brought some analysts in to help us and give us some horsepower, but the core of the decision-making really occurs with David and myself. But we're really happy with the team we've got and I think the capability we've built in the space. So why invest in the global small company space? What is exciting and interesting about it? This is a very high level view, but I think, Fama French has a famous factor model that all of us probably know who've studied a little bit of finance. And really, I think they narrowed down 3 aspects of returns. One, beta, which is obviously market exposure, and then value and small cap. And we are a value small cap manager. So I think through us, you get exposure to a lot of the fundamental inefficiency in the market, and hopefully you get a chance to capture that over time. But how does that actually, is that a real thing? How does that bake in the numbers? I think here you can see, what global small caps, how the performance has been over the last 20 years compared to those global large caps. And what you find is over the last 20 years, you have over a 7% return in the global small company space, versus just under a 4% in the large cap space. And we think that's really meaningful, right? Over time, compounding at 3% is a really meaningful number. And so we would expect this to continue, but just gives you a flavor of, how big an outperformance you really see in the small cap space over time. So, and I think one thing that the folks over at Pengana have been really helpful in highlighting is just kind of what the weighting is of global small caps, and then how invested Australian investors really are in the space. And here you can see global small company, global SMID caps make up almost 32% of the global market cap. So 32% of all listed market value out there is in the global mid space. However, Australian investors only have a 3.1% allocation to the space, and we think that's a big misweight. You know, in our view, back to what Brett said, you know, we think it's a very interesting space for investors, especially in Australia, and we think there's a big under allocation to the space, and we just think that that's something, you know, hopefully we can help address over time here. And then I think the second piece, and the question we get a lot, is what passive versus active. You know, the passive versus active argument really hasn't come down to our space yet. And the reason why is there's just so much alpha generating opportunity in the small cap space. And what is the reason for that? Here we kind of touch on it. You know, over 99 or 98% of companies in the global small cap space are totally uncovered. And then if you just look at the number of average analysts covering the names that are covered, you only have 5 covering a small cap versus 22 for a large cap. So we believe kind of, again, that orphan universe, there's an opportunity to really get an analytical edge by going and doing your own research, finding these companies, talking to management, doing your own research, and creating an informed opinion that really doesn't exist in the large cap space. And we believe that's a big driver for why active management in the space will outperform over time. I think the last piece again here is, and this is Australia specific, there's just not that many opportunities for Australian investors to get invested in the space. Have a lot of here listed large cap Australian funds, a lot of listed small caps, and quite a few global large caps, but only 6 funds in the unit trust structure that are addressing the global small company space, which we're one of. And we think that's part of the reason there's just a persistent underinvestment in the space, despite it being a very attractive space. Those who think, and then I think the last point is, how different is this space versus just kind of a global equity exposure? And our argument is it's quite different. There's many more companies compared to the global large caps, but I think, from a valuation standpoint, probably more specifically in a sector standpoint, you're getting a very different sector exposure that you can see in the chart in the bottom left of the slide, as well as a much higher dividend yield. And I think those things are pretty powerful. You're investing in a space that not only tends to generate higher returns on capital over time, but you're investing in it at a time where it's a bit cheaper, and you're getting a nice diversification in the sector exposure that you would typically have as an Australian investor. So let's touch a little bit on Lizard's investment strategy. How do we do what we do? And how have we really built our philosophy and our execution, and what is a challenging space to invest in over the last 10 years? I think at the heart of our investment philosophy is really around, we are long-term value-oriented investors. We really believe in fundamental deep dive research. So I think our 2 key advantages are sourcing ideas and diligencing them. We'll typically hold an investment for 3 to 5 years. So the team is really built as a generalist team. We want our team focused on the best investments we can find at any one time without forcing capital allocation into certain industries or geographies. And then, we spend a lot of time finding what we think are really interesting, good ideas. We want to be able to concentrate capital in those ideas. So our top 10 investments tend to have about 35 to 40% of the portfolio in those top 10 investments. We think that's really important. And I think there are 2 things. First, we think that's a big driver of returns over time and the alpha generation we talk about. But second, it also limits the amount of capacity we can manage. So we can only manage so much money in our strategy, given the fact that we are concentrated in the small cap space. And so how do we do that? What allows us to do that? It's really around finding very high quality franchises and businesses. Our number one focus of our investment philosophy is finding a high quality business that we think can drive value over time. So drive its intrinsic value over time, and thereby drive the value of the fund over time. And I think really these high quality businesses with great balance sheets, and I'll talk a little bit more about it in a second, are really the core component in terms of not only preserving capital, but also driving returns for us over time. So how do we think about a quality business? The quality businesses that we try to get into the fund. We think about it in a couple ways. The first and most important piece is really the business model. We want to find a business that has a sustainable competitive advantage, as we think about it, that will allow it to earn high returns on capital over a long period of time, and grow the value of the business. And we spend a lot. We really call it the engine of the business. What really makes an engine of a business go? We really need to understand that. We need to understand why it's different from what else is in the market and why they're going to be able to create quite a bit of value over time. The second thing we look for in every investment we make is a strong balance sheet. So we want businesses that are self-funding through almost all market cycles. And we think that's really important because we think when, given a downturn in March and we've lived through a lot of them, having a balance sheet where you don't need to go dilute equity holders and you can be aggressively expanding your market position in downturns is really critical in terms of long-term value creation. The third thing we look for is a management team that's aligned with us. So not only do we want a good business with a good balance sheet, but we want managers who are really aligned and who own hopefully big chunks of the business we invest in and are really focused not only on driving the value of the business, but also, again, back to capital preservation, really being aligned with us if we lose money. The fourth thing we think about is corporate governance, and we think about that a little differently. Corporate governance for us is really critical. Investing in some non-Anglo-Saxon jurisdictions, we need to be really careful about making sure that the companies we invest in protect us as partners and treat us fairly as shareholders. And that's something we spend a lot of time focused on. And then the fifth piece is really a valuation piece. And this is really simply put, we want to be earning 20% a year return when we put capital to work in a business. The simple way to think about it is that we want to be paying about half of what we think the business is worth on a 3 to 5 year basis. And that's really the last piece that actually gets us to invest in a company. So what does a portfolio look like once we've kind of scoured the world, found these companies and gotten invested in them? Portfolio will be typically, we have an exposure will be between 80 and 100% long. We can hold up to 20% cash, but a more typical cash position for us is around 5%, which is right around where we stand today. Concentration, again, let's say typically around 40 positions, maybe a few more, maybe a few less. But again, that top 10 will represent about 35 to 40% of the portfolio and be pretty meaningful for us. Again, time horizon 2 to 5 years. The historical annual turnover has been right around 40%. That's ticked up a little bit this year as we had a pretty active spring given everything going on, and I'll talk about that a little bit later in the presentation. And I think most importantly, from a top-down perspective, from a portfolio construction basis, what we're really trying to do is give you the bottoms-up fundamentals of the businesses we're invested in, but not take too much risk in any one sector or geography. So we look across top-down across sector, geography, and currency, and really make sure that there's no big thematic bets running through the portfolio. And that's how we seek to control quite a bit of our risk. So now, hopefully that was a reasonable overview of the strategy. I know it was a little bit brief, but I think hopefully most of you have some exposure to us so far, or some history with us. Now I want to spend a little bit of time talking about the current environment. I think it's been a very unique and interesting environment, and hopefully we've got some questions at the end of it. But let's chat about it a little bit. First thing I'd like to talk about is just taking a little bit of a step back and where do we sit in kind of the overall, capital allocation universe and where are we sitting in the small cap, right, where small cap sitting right now. I talked a little bit about small caps really outperforming larger caps over a long period of time. We talked about that early on, and what's been interesting is the last couple of years that has not been true. I think, the performance of U.S. large caps, especially in the tech space, we've all sort of seen it, we've all talked about it. Here you can see it graphically, and what we really see here is right now small caps are quite a bit out of favor. We're in a period where small caps have underperformed for the last couple of years, and we think that actually makes for a very interesting entry point. We think there's some catalysts as to why that's starting to reverse, but we do think that's a pretty interesting entry point when you're looking at the global small company space, is the fact they are quite out of favor right now. The second piece I'll talk about, and the biggest question we get is sort of right around U.S. versus rest of the world, and so this slide really shows where we're at in U.S. against the rest of the world. So the top of the chart would indicate when non-U.S. equities are outperforming. The bottom half of the chart is when U.S. equities are outperforming, and what you can see is this is cyclical over long periods of time. It's not like U.S. always outperforms, but we are certainly in a period where the U.S. has outperformed pretty dramatically. In fact, it's been similar to what we saw leading up to kind of the 2000 dot-com crash. So we also believe international is now in a position where we could start seeing some pretty serious outperformance on the international space. And we think this is a good graphical way to show kind of how big the gap has become. So moving on, and then, what has happened most recently in the fund and since the crisis here is a 1 year ending in kind of the alpha generation we've been able to generate. I mean, here you can see the fund has actually performed really well in the last year. We've generated about 12% alpha across the board in the fund over the last year. And it's really come across a multiple of sectors. And on the next slide here, you can see it's across a multiple of regions. And I think, what we've seen is kind of what we've been talking about a little bit is we're starting to see that reversion to global small cap value starting to outperform a bit. And I think here you can see in our numbers, and I think we're very optimistic that this is something that will carry forward for the next 3 to 5 years. So, more recently, how did we navigate the crisis and generate some of that alpha? What have we been doing? The crisis is an interesting time period to talk about for all investors. I think it was unique in terms of other sell-offs we've been through. It's something that none of us have ever lived through a global pandemic before. So I think it's a pretty interesting period to talk about. Back in January, I would say it became really obvious that this crisis was going to become a global crisis for us. I sat down with the team and really laid out 2 goals. The first was really to protect capital in the short term. We wanted to take actions to protect the book, given that we were entering a period of really significant uncertainty. And the second thing we really wanted to do, and something we really focus on, is acquiring superior businesses that we think could drive the portfolio for the next 3 to 5 years. We spent the last 12 years meeting with hundreds and thousands of management teams, and we've built a list of what we think are the really high quality businesses in our space. And so we wanted to use this opportunity to really put our institutional knowledge to work and get invested in some of these really high quality businesses at discounted prices that would drive the portfolio for the next 3 to 5 years. So how did we execute on this? The first piece, and I think the thing we've been asked a lot is, how have you been able to interact with management teams? We travel quite often to meet with management teams. Obviously, we've been utilizing phone and Zoom and all those types of technologies, but we dramatically increased our interactions with management teams at the end of February and through February and March. I would say typically for us, we'll have 300 to 400 management team meetings a year. We had 178 meetings in about a 5-6 week period to really get a sense of what was happening in the end markets. Some of the end markets we were concerned about, some of the end markets we were more optimistic about, and certainly things like China. By the time March had rolled around, China was actually starting to rebound. So we were able to get a flavor of a lot of different things through those interactions, and we were able to execute on that in the book. And you saw kind of that increased trading activity I spoke about. We were able to put in 12 new positions into the portfolio, and again, that's in a 40-name book, so that's a pretty significant increase. I'd say influx of new ideas into the portfolio. We also exited 8 positions and reduced 19 other positions in areas that we were a little more concerned about. So again, we were quite active in that period, and with really those 2 goals of protecting capital and making sure we were buying those businesses that we were thinking going to be able to take advantage of the downturn and really drive value for the next 3 to 5 years. And just moving on to where we sit today, I would say so far that's been pretty successful. I think you can see it in the portfolio performance. Where do we sit right now? We're really happy with the portfolio. We continue to be really happy with the pipeline we're seeing. But where do we sit now? Obviously, markets have really recovered around the world with the help of a lot of liquidity and stimulus from governments. I think we are seeing, the stimulus so far this year really dwarfs anything we've seen in the past. You're probably 3-4 times larger than what we saw on a global basis, larger than what we saw in the great financial crisis. So we've seen a lot, there's a lot of liquidity and stimulus out there. There are some risks out there, right? There's quite a bit of economic concern out there. And I think the biggest concern I can see is really unemployment around the world. You're seeing that start to come down, but certainly not at a really rapid pace and not at the pace with which it increased. So that's something we're keeping our eye on. The second, I think the one really interesting thing that's happening right now is the capital markets activity is just off the charts. The US is going to have its biggest IPO year since 2000. You're seeing similar things happening in Brazil and South Korea. And I would just say there tends to be a correlation when you see really high IPO activity, all these SPACs coming to market. It feels a lot like it did near other market tops and other frothy periods. So I think, we do perceive some risk in the market. You also have a US presidential election coming. So I'd say obviously the next couple months in the US and even on a global basis, I think the presidential election will be really critical. And I also think, the market is, the market success in the near term will be really predicated on stimulus. And I think if we don't get it, you can expect some choppiness. That being said, I think we're quite constructive on a 3 to 5 year basis on the international small cap space. The U.S. current account deficit, which really measures how much the U.S. is borrowing to fund its spending, is widening pretty dramatically. The current U.S. dollar currency is also 10% above its purchase price parity, and those are two things that we think are potentially really negative for the U.S. dollar, or could be somewhat negative for the U.S. dollar. If that does play out, that's actually very positive for ex-U.S. equities. So I would say we perceive some near-term risks. Overall, we're pretty optimistic on this global small cap space, certainly on a 3 to 5 year basis, and we're especially optimistic on non-U.S. global small caps. So how we position the portfolio in that regard? Some of this will not come as a surprise at all, based on what I was just saying. The growth versus value debate has become even more extreme. Basically on any valuation multiple, on things we track, values become, on a relative basis, as cheap as it's ever been against growth. But we don't think it's, we think there's enough going on in the world with secular changes in certain industries, with capital formation the way it's occurring, that it's not so simple as just buying value and buying growth. We think it's going to be really important to just really stick to our core principles of finding underloved, high quality businesses that can create value and buy them at cheap prices. And so we really try to stay away from the growth versus value debate and just stick to what our core competency is, which is finding sort of underloved businesses and making sure we're getting invested in those businesses. We are trying to stay away from areas where we think there's going to be potentially long-term demand problems. I certainly believe people will travel again. All of those types of things will come back. However, I think the duration is uncertain, and we're just not sure how much capacity needs to come out of certain industries. And we don't want to sit around in those industries when capacity is coming out, because we tend to believe that's very negative for equity prices and a lot of different issues. So we're trying to avoid those sectors where we think there's potentially some serious overcapacity. We continue to be underweight the U.S. based on what I just talked about, both on a valuation and sort of catalyst basis. We see a lot of, we're pretty optimistic about the ex-U.S. space right now. Again, I talked about, we always measure sort of internally how, what is our pipeline activity? And that is, what are kind of the new investments we're seeing and how attractive are they? Our pipeline is still really robust. We're really still quite excited about the things we're seeing. And that gives us optimism about what's going into the portfolio. It also allows us to exit those names where the IRRs are not quite as good anymore, those names that have hopefully been pretty successful investments. So I think that's all pretty optimistic for us. Again, though, we have, I think by exiting certain sectors, we've tried to position the portfolio a bit conservatively, given what we think could be some near-term challenges around the presidential election, around sort of the capital markets activity that we're seeing. And so I think it's a balance of being very opportunistic on the pipeline, but also having a conservative overall positioning. And I think most recently, we are optimistic that we're on the right track. A lot of the companies that have reported recently have reported quite good numbers in the book. And so we're seeing traction fundamentally really across the book, with the exception of maybe 1 or 2 positions. So that's a bit about how we're positioned today. And I think we feel pretty optimistic about things, with the caveat that we certainly wouldn't be shocked at some near-term volatility. So I talked a little bit about the accelerating secular changes, and how they're, and how we're investing around that. And what I mean by that, it's just something I want to spend a minute talking about here. I think this is, certainly in talking with David, and we've both been doing this for over 20 years now, the last 12 years here at Lizard. I think this is the fastest we've seen the competitive dynamics in certain industries change. And so we want to be very aware of that. And I think that's why it's a little bit tricky to be a value investor in certain ways, in certain sectors. But I do think there's a tremendous amount of opportunities, and we just want to make sure we're in the right places. And I think we're looking at things like the work from home trend, online consumer spending. We want to make sure we're involved in investments where there's just really critical business services that won't get disrupted, or those businesses that are really helping consumers deal with, a more challenging consumer spending environment, a more challenging, employment environment. And so I think those are all the things we are looking at, making sure we want exposure to, again, avoiding some of those industries with potentially big cyclical downturns or uncertain demand profiles. And some examples of that, BHG, we'll talk about it a bit. Canvy and Kindred are both online sports gaming businesses that have quite a bit of exposure to the growing US market. The work from home trend, we'll talk about Fiverr here, listed Fiverr a bit, but Avast is a business that helps people with virus protection and VPN and all sorts of good things where demand is really strong, where we're not paying a really high price for these equities. The credit bureaus will always be really critical for banks. Dino, which is a hard food discount retailer in Poland, again, tends to take a lot of share when people get a little more worried about their wallets. So these businesses are all long-term investments for us, but also have not only attractive valuations and attractive fundamentals, but also some tailwinds that we think could continue to drive the business for the next 3 to 5 years. Here's a snapshot of the portfolio as it exists today. 50 positions, so up from 40, and I think that's really a factor of those 12 new ideas that came into the book in the spring. You've seen an uptick in the number of positions in the book that obviously has caused a little bit of diversification, but ultimately top 10 are still 35% of the portfolio. This really highlights some of the weightings I was talking about. And I think on the left, the regions, you can see us very overweight to Europe and very underweight North America. We're happy about that. I think the chart on the right under market cap, I think it's also important to note, and this is more of an evergreen thing, we are always going to skew a little bit smaller than the underlying index. And that really is, again, back to that focus of finding sort of the under the radar orphan companies. So we really try hard to deliver on what we consider kind of that small cap space. And you see that in the weightings where our weightings in under $2 billion US dollar market cap are much higher than what the index is. I'll talk a little bit about performance and statistics and what's been happening. Actually, what are the numbers the fund has generated more recently? We talked a little bit about the alpha, but here you can see the numbers. I forget the exact stats, but over the last 6 months and a year, you've seen the fund perform really well. Fund's up over 20% in the last 6 months. In the 1 year number, it's up over 7. The index is down 2. You've seen a good amount of outperformance, and I think I've talked about some of the reasons why. Some of the headwinds back in 18 and 19, which were really larger caps outperforming and US outperforming, which really impacted the fund, are really reversing now. We think that's really the beginning of the trend. So we're pretty optimistic, and this is, I think we've outperformed since inception. This chart, highlights a little bit, and I won't get it too into the details here, but what it really is telling you is that the black line is our stock performance. The beige or gray line below it is the index's stock performance. And what it shows here is we've really outperformed from a stock picking perspective in really every market cap. However, our weighting, which are the bar charts, our weighting is much more heavily geared towards that small cap space. And that's really what drove the outperformance, the underperformance on a 3-year basis, was more the weighting to small caps than anything from a stock picking perspective. So again, as we see that kind of international small cap reversal, we think it's pretty optimistic for the performance of the fund. And last, let's touch on, we'll talk about the top 5 positions in the book and some case studies, and then hopefully we can get into some Q&A. Our top holdings as of the end of September are Boohoo, which is an online retailer in the UK. Nice Information Services, which is a credit bureau, the monopoly credit bureau in South Korea. And effectively what they do, they would house all the credit data for individuals and credit scores and all those sort of good things that allow banks, credit card companies, mortgage providers, or whoever it might be, to provide credit for companies, for individuals. And again, a very high quality, sticky, recurring business. Kindred is a sports gaming operator. It's a UK listed business, obviously based in Malta for licensing reasons, but really has its roots in the Nordics. One of the leading European operators, and I think a business we're really happy about and happy to own. We bought it in a period of pretty significant disruption about a year ago, a little less than a year ago, when sports were being canceled around COVID, as well as some regulatory changes in Sweden occurred. We had an opportunity to invest in this business, and one we think will drive quite a bit of value over time as they start to penetrate the US, which is opening up to sports gaming online. TFI International is a founder-led shipping business where you've just seen a founder who has generated phenomenal returns through very disciplined operations over time, a business we're really happy with. And the fifth one is Dino, and we spoke about that briefly, which is a hard food discount retail company in Poland, which has just been a phenomenal unit rollout story and has created really significant value over time. Again, owner-operated business. The founder here owns just over 40% of the business, and is really focused on value creation there, and that's something we love to see. So just talk about a couple stocks and the kinds of things we're seeing and opportunities we're seeing, and some of those secular changes we're talking about. Fiverr is a business that we invested back in February, March of this year. Fiverr, at its core, is an Israeli business listed in the U.S., but what it effectively is an online marketplace for freelance services. So obviously there's with the growing of sort of the latest generation of the gig economy, which is more freelance-based work, you've seen a lot of employees want very short-term contracts, whether it's graphic designers who want to get paid $200 to design a website or wherever it might be. Fiverr has really created an online marketplace for these people to go. So rather than kind of the word of mouth or classified ads that occurred, 2 years ago, Fiverr has really created an online marketplace where small, medium-sized businesses can find these freelancers, create a contract, and execute on a contract right on the website. It's obviously been very much right time, right place, as you've seen a dramatic increase in need for this service given the current environment around COVID. But this company has really been growing really dramatically over the last 3 years, 5 years. You've seen it accelerate more recently, and you see that reflected in the stock price. But again, back to these new businesses that are really being created by this need. What we think is, even as life hopefully returns to normal in a year, once you start using the internet in this way, I draw a comparison to online dating, right? Once you started using online dating, you still went to bars to try to meet people to date, but you still, you never went away from the online dating, and so we continue to believe in situations like Fiverr where, yes, you're seeing an influx of demand here, but we don't think that demand goes away over time. We think it really is changing behaviors and changing how people interact. So I think an example of a very exciting business, but also right time, right place, but a business we're extremely excited about, and some of the secular changes we're trying to take advantage of in the portfolio. FDM Group, a bit of a similar high quality business, that we invested in, again, in a similar time period. This one was a little bit later in April, May of this year. But FDM is a really exciting business services business in the UK. They effectively take non-traditional college graduates or military members who don't have business degrees, put them through a 14-week training period, get them employed at really high quality jobs. Those employees receive a bit of a discounted salary, and they employ these people for 2 years, and then most of them end up working for whatever, maybe it's Lloyd's of London or whatever bank is out there, or consulting business. And what we've really seen here is FDM is really interesting because in our mind, they're taking high quality people who maybe haven't had the same, educational background or have a military background or whatever, and find them these really high quality jobs. There's a social need there they're solving, and they're solving it in a really constructive way. And so this is, again, a founder-led business. We think it's a huge opportunity. There's no competitor in the marketplace, and it's great for employers. It's great for the employees, and a business we think will continue to grow for a long time. They're expanding internationally. They're expanding into different verticals, and again, a business we're really excited about. BHG Group is a really interesting business in the Nordic region, and they are an online DIY and home furnishings retailer. This is a business that sort of floated under the radar for a while. We acquired these shares, I think it was May or early June of this year, but effectively they've created a dominant position in the Nordic market. For those of you who don't know the Nordic market, it is a small, Sweden, Finland, Norway, Denmark. It's a small niche market. They're a little under 30 million people. It's been a bit, it's too small for a lot of guys like Amazon and others to go in. So you get these really compelling local internet businesses or whatever it might be. And I think BHG has become a category killer in the DIY and home furnishing space. it's still very early on in the penetration curve of online to offline, but we're seeing that grow pretty dramatically. Obviously, again, they've started to benefit really dramatically from what's going on in COVID. It's a management team we've known for quite a few years in their prior world. So we love the management team. We really like their market position. And again, a situation where we think this business can compound and grow for quite a period of time, given some of the secular tailwinds they've got. So that's really it. Those are a couple of case studies, and I think hopefully that gives you a good overview of the fund, what we've been up to, how we've been positioning the book, and hopefully a bit about what we think is going to happen in the next 6 months to a year. I'd like to turn it over to Brett and hopefully open it up for some Q&A and go from there.
Thanks, John. That was very interesting. We've had a number of questions roll through, but sort of two thematics, one US election and then one more portfolio related. So I might sort of just ask a couple of US election related first, and then we'll stay on the portfolio theme after that. The first one's actually quite an interesting one, but it's probably more a question of you as a US citizen rather than a portfolio manager. What do you perceive as the biggest risk to continuing civil instability and tensions in the US? A Trump win or a Trump loss?
I think that's a really good question. Frankly, I don't know the answer to that. And I think that's the $1 million question. In terms of civil instability is, I think, probably too great an overreaction. I certainly think if Trump wins, you're going to have a lot of angry people. And if Biden wins, you're going to have a lot of angry people. So I think in both cases, you're going to have quite a few angry people. That being said, I think, my sense is I think, Biden has a skill set that would enable him to generally calm the angry people in a way, in a better way than maybe Trump is positioned to calm down his sort of adversaries. So if I had to pick, I'd say I think a Biden win creates more stability. But that being said, I think both have their factions of fairly angry people, and I think there's some real reasons why that's the case. And I think I think these things are things that the U.S. is going to have to work through for the next couple of years.
And just as an extension to that, from a portfolio perspective, you've mentioned there you're underweight US, overweight Europe, but for the US holding specifically, does the portfolio look any different on a Trump outcome versus a Biden outcome, or is it the actual wording of the question was, do you have a red scenario versus a blue scenario for construction?
So I'll answer that question in two ways. The first is, if I were to take a really general view and say, what's better for the market, Biden or Trump? I do think the market may react negatively if Biden wins, mostly because of tax reasons. I think it's a negative tax connotation, not only for citizens, but for corporates. And I think that'll have, an adverse reaction in the stock market. Second question, our book specifically, unintentionally, we are a bit pro-Biden, I suppose. We're more blue, and that's not really for any, it's not something we've intentionally done, but we do have an allocation to cannabis, and we do have an allocation to sports gaming here in the US, both of which Biden has talked about legalizing on a federal level. And if you saw federal regulation of those businesses and those industries, I think you'd have pretty explosive value creation not only in the industries, but I think you'd see really a dramatic ramp in stock prices. And so I think, for those reasons, I'd say we're probably, I don't think a Trump victory hurts us, but I think a Biden victory could really help a few stocks in the book.
Thank you. We'll move more into the market related to the portfolio type questions now. Which of the companies in the portfolio do you see moving up the market cap spectrum to potentially being the future superstars or heavyweights? And as a secondary to that, at what point do you need to, get out of those stocks as they become more mid or large?
Yeah, and that's something when we designed the fund with Russ and a couple of the folks at Pengana, something we talked about, which is we didn't really want to be forced sellers of businesses that were performing well because of artificial market cap size restrictions. And so what you see is, our commitment for us to have our median market cap below 3 billion, which we beat by a mile. I think our median market cap tends to bounce around between about 1.1 and 1.5 billion or 1.4 billion over time. That being said, I think we sort of view our hard cap on a market cap basis as 10 billion US dollars. So we do have room for those small businesses that are really growing nicely, really executing well to continue to grow. And you've seen that in businesses like Fiverr and a couple other businesses we're invested in. I would say in the specific question of what's in the book today that we think could become really big cap, I would say that the name that comes to the top of the list that I can't talk about, unfortunately, because we're still buying it. But I think that's something we'll talk about in the near term monthly letters. But I think it's going to be potentially a really interesting idea. I think the businesses with really long-term opportunities to grow quite a bit of value, I'd point to Camby, which is a sports gaming technology business in the portfolio that really services the back end and front end for a lot of the sports gaming companies here in the US. They have 20 years of experience in technology in Europe that's being ported over here to the US. So it's a pretty interesting situation. I think I think Canada Goose has an ability to grow really dramatically in China that would really increase its market size and thereby probably its market cap. And I think I think there are probably 5 to 10 businesses we look at that we say, this could have, these guys could have 5 to 10 year windows of really serious compounding. So those are a couple. I'd love to touch on all of them. And if we have a lot longer, I'd be happy to. But I think those are probably 2 I'd point you to.
Beautiful. Thank you. Another one's just come through. It's a good question. What do you see as some of the triggers to start the reversal towards small caps over large/mega? Are we starting to see evidence of this over the past couple of months?
Yeah, I've wrestled with that question a bit. I see the reversal from international, US to international a little more clearly from a catalyst perspective. I think the small cap, I think you are starting to see it a bit, right? So you had small caps really underperform in the early part of the year in the crisis, and that's normal. And now you've seen small caps rebound faster than large caps coming out. I think but the thing that I think, may start to happen is really sort of the fund flows. You have some fund flow issues, kind of forced capital allocation through whether it's, the way that, what we call, what a US investor, their superannuation plans are called 401k plans here in the US. A lot of those have kind of automatic capital being infused into these mega caps. And I think you need to start to see a reversal of some of that. And so I think on the margin, we're starting to see some of it, but I think part of it's fundamental, and I think that will occur. I mean, I don't know if you saw the fact that the DOJ, the Department of Justice here in the US, is going to go after Google. I think if things like that start to happen, that'll create a catalyst. But then I think you also need the fund flow issue to change, and I think that's something that is a little bit more unpredictable. But I think when it happens, it's going to happen pretty fast.
The next one that's come through. Now, you mentioned that IPO activity has returned globally, particularly in the small caps world. Now, in Australian small caps, there's been a rush on companies in the buy now, pay later or payment platform space. Are you seeing the same phenomenon globally? And if not, is there a sort of a particular sector where they're seeing a flurry of activity for IPOs? Yeah,
I mean, look, I think the payment space has been pretty hot around the world. You've seen it you've obviously seen it in Australia, a little bit in Europe, definitely in the US. But I think it's, so I think, yes, the fintech space is one of the really hot areas. And we see quite a bit of capital chasing those opportunities. And I think anything that can kind of label themselves as a SaaS business model is also getting quite a bit of attention. We see some stuff in the education space in various places in the world starting to get some more attention. And that's the education space is, if it's a service provider, that's great. If it's an actual educator, we always wrestle with kind of the should you be making money on teaching people issues that sometimes we see. But I'd say, I think you touched on probably, technology and fintech certainly seem to be the 2 hottest areas we seem to see capital being raised.
One more, a little bit more of a sort of macro flavour. Do you see Latin America as a growing opportunity in terms of tech and financial services? The region's underserviced banking wise, and there's a few tech disruptors entering the market.
So, I think so. I think yes. I think so. Example, there's a business in Brazil called XP that IPO in the last 12 months, and really a phenomenal story in kind of the advisory space. So Brazil has a very concentrated banking market. They're disrupting a little bit of kind of and a lot of investors in Brazil invest through the banks. And they're disrupting that a bit. I think there is massive opportunity for disruption in South America. And you have a few companies that are really positioned well to do it. That being said, you have to remember South America's, when you look at the specific economies there, the winners tend to be really concentrated. So banks tend to be really concentrated. And so it's really hard to break them, right? It's not like the US where you have 3,000 lending institutions. In Brazil, you probably have, 6, 7 that really matter, and that's it. And so, you really have to take on big guys to win. And so, I think South America for us, I'd say the caveat with South America or a lot of Latin America for us is the macro can more easily overwhelm any stock-specific stuff that happens when you make investments there. So you have to be very aware of the macro. The secondary piece is, do we see disruption occurring in South America? We do. In Brazil, there's a ton of IPO activity. We're a little bit worried that it's a bit of a hot market right now. So, one of the things that has been really fruitful for us over time from an investment standpoint is investing in broken IPOs. And so we love all this IPO activity. We probably won't participate now, but I think what we tend to find in the next 12 months is if a bunch of those businesses will have some hiccups, and it'll give us an opportunity to buy some of these really interesting innovative businesses at hopefully discounted prices from where they're IPOing today.
Beautiful. And one more, we'll move back over to the continent. European countries such as Iceland and Denmark have handled COVID more effectively than larger economies such as Spain, Italy, and France. Has this created any new opportunities within the portfolio?
Oh, interesting question. I don't, what I would say is, I think what we've looked at with COVID is more, unfortunately, it's become more of a negative, like, hey, where shouldn't we be investing, rather than, hey, will Denmark maybe outperform the rest of Europe, given it's handled it better? I don't think we've really gone down that path. It's more gone down the path of, hey, there's a really interesting gym business, in Europe, kind of a low-cost gym operator rolling out units, really attractive. I think, unfortunately for us, is those are kinds of situations where, given how poorly some of Europe's handling it, and some of, frankly, in the US, how some states are handling it, we just are a little more hesitant to get involved in those situations. So I think ultimately what we've seen in our portfolio so far is it's been more of a, hey, we need to stay out of certain areas, maybe a consumer-led business in France and Benelux, rather than, hey, we should be allocating to stuff in Denmark because they've done a better job. But it's interesting, because if you look at how Sweden's handled it, and I think Sweden's a small country, they've sort of gone the opposite way and pretended it's not happening. And initially that created a lot of problems. They seem to be coming out of it now. But yeah, I would say, it hasn't really shifted overall allocations that much, but it has precluded us from making some investments we otherwise would have made.
Beautiful, thank you. Just sort of very similar theme on the COVID trail, particularly for Europe. Now you mentioned there Dino Polska will do well when consumers are sort of watching the hip pocket. But what effect does sort of record numbers in Poland have on a stock like Dino Polska, which is in the top 5, top 10?
Yeah, Dino Polska has been in the book for 3 years. It's been a phenomenal performer for us. So I think taking a step back, right, Dino Polska just is sort of a very unique business in that it is penetrating an underpenetrated market with a really good offering for consumers, and really, effectively converting a lot of people who used to in small towns, converting a lot of people who used to shop at mom and pops to a more retail store oriented format. They save 20 to 30% when they go shop there. I'd argue the supply chain is more traceable. You have more probably comfort level if you are worried about COVID going to a place like Dino than you would to your mom and pop grocery store. So I think from that perspective, it all aligns well fundamentally. We haven't seen, we've seen the stock get hit a few times, but I think given they operate in kind of that food grocery space, they're viewed as pretty defensive. We wouldn't expect that to have as big an issue as maybe some of a more cyclical business, So we had, like, for example, Servet in Italy, which is a credit bureau, did trade off a bit more on macro concerns around the Italian COVID issues. We don't fundamentally think it'll really be a long-term issue, but in the short term on some of these stocks, I think it kind of depends on how they're viewed in the market, how cyclically they're viewed in the market versus and how they're hit. But we aren't really moving kind of long-term capital allocation around, given where COVID is really popping up yet. Just because we think most of the stuff we own is pretty well insulated, and we went through that exercise in sort of March and April and really took out a lot of the stuff where we thought there could be pretty significant exposure to long-term demand problems.
Beautiful, thank you. We've just had another one roll through in relation to one of the larger holdings. So fiverr has gone up 350% this year. As you mentioned, we're probably operating in the most favourable environment for it. Even if there is permanent changes in behaviour, wouldn't it be over-earning at the moment, and wouldn't that be reflected in the share price?
So say the last part of that question again.
Even if there is permanent changes in behaviour, wouldn't it be over-earning at the moment, and wouldn't that be reflected in the share price?
Yeah, I mean, fiverr's sort of unique. Yeah, I mean, I think fiverr's kind of way on the growthy, more expensive stuff of things we've done. In terms of how we handle stuff like that, just to give you guys a frame of reference, right? We've probably sold about 50-60% of our fiverr stock over time as the share price has gone up. Our IRR comes down. That being said, I think, and this is a debate we have internally, is that fiverr's potential market size is enormous, right? I mean, I think they've really only started to scratch the surface of how big this business could get, especially given some of the traction they're getting. This is not a business just operating in the US now. They're operating in multiple countries, showing really rapid growth in multiple geographies and multiple languages. And so, I think what we've learned over time, and I think fiverr, is maybe an extreme example of this, is those businesses, when we find a really high quality business that has a really big market opportunity, tend to create a lot more value than you can ever imagine when you first buy it. But we have brought down the weight of fiverr. We understand that the argument that, optically it looks expensive. And so from a risk control standpoint, we brought down the weight. I think even if it went to zero tomorrow, we still would have made really significant money on the position given what we've sold. So yeah, I understand the argument that optically can look a little bit expensive, but we think the market size there is probably much bigger than most people realize. And we don't, again, this is a situation where we think, we aren't, it may grow a little bit slower than it's growing right now, but it still will grow a lot over the next 5 to 10 years.
Beautiful. And we do have still a few more questions here. We might make this the last one, just so you don't have to rush the answer as well. You spoke about accelerating secular change in the themes that are benefiting from those changes. Is this a thematic fund? Can you talk a little bit about how you source your ideas?
No, yeah, I mean, so we're definitely not a thematic fund. We're very much bottoms up oriented. I think these are observations, on the, these are kind of observations we make. And I think we would definitely classify ourselves in the value investor camp, probably more like a Warren Buffett in terms of looking for high quality businesses, rather than sort of that deep value asset purchaser. And so I think our observation there is really around this argument, and what we've seen and what we've been wrestling with a bit is how to, we understand quote unquote traditional value price to book stocks are really cheap, right? But given some of the things we're seeing in the environment, I think we have to be a bit mentally flexible in terms of how we think about value creation in businesses. And so this is more an observation of what we're seeing in the real world and what's actually happening in the businesses, and not so much about, we're going to be thematically all in kind of these sectors. Because I think there's a lot of businesses right now that look like they're growing really fast that will end up having very bad economics. And so I think you have to be really careful and really selective when you do invest in businesses like that. We do own a few in the fund, and then we own businesses that are much more on the value end of the spectrum. You know, really, I think an example just to kind of bring that to light is sort of in the US, probably one of the most interesting debates in the used car space is Carvana versus CarMax. And so CarMax is a business we own, you know, is the dominant used car seller. They have about 10% of the market here, which is and they're, you know, much larger than anyone else in the market. They're the traditional kind of hub and spoke. They actually have stores, all that sort of good thing. Carvana has tried to create a totally virtual used car sales platform. And they're growing really rapidly on the top line right now, but they continue to lose money on every car they sell. And we really haven't seen, from our perspective, any scale in that, right? So as they grow, they don't make more money or lose less. And that's really concerning to us. And so, you know, we look at, you know, you have to really, those businesses that if I give anyone enough capital, they can probably go figure out how to generate revenue, but it's how to do it profitably with high returns that really becomes challenging. And that's why I think you have to be really careful about where you invest. So we're not thematically looking for these, you know, just growth areas. We're very much company by company looking for businesses with high returns on capital that we think can generate value over time. And we're happy to own businesses that grow fast and some that grow slow, but it's really about that quality of the engine underneath and the return on capital that business generates that really drives our investment. And so, no, we're not thematic. It's really a bottoms up, truly a bottoms up fund.
Beautiful. Well, just one more which has popped in, which I might get a quick response from you on, given your value bias. John, our house view is that the asset performance equation in terms of growth versus value is continuing to gap, with growth outpacing value over most time periods, 1 year, 2 year, 3 year in particular. Mm-hmm. What's your gut feeling on, is the tide starting to turn, or when will that sort of reverse?
Yeah, I'd say gut feel. You know, we're in a period of really extreme IPO activity. Capital formation is crazy. You know, there's a ton of liquidity out there. I would say if something happens to liquidity in the marketplace, that change, you know, when that happens, and that's something we keep our eye on. When liquidity in the overall market changes, that trend will reverse violently and quickly.
Beautiful. Thank you very much, John. Appreciate it. We might wrap it up there. There's still a few questions outstanding, but we'll get back to people on those. And there was a few sort of on the election outcome as well, but I think we covered off on that in the presentation and at the start of that Q&A. John, again, thank you very much. To everyone who's joined the call today, thank you very much. We really do appreciate your support. We are sort of seeing some great momentum for the fund at the moment. You saw the numbers relative to the SMID index. You know, there's a limited universe for good quality global smalls available here in the Australian market, and we certainly do have one here. So the differential against the you know, peer universe is sort of equally as strong from a performance perspective. So yeah, the team have done extremely well in what has been a very turbulent 12-month period. So congratulations to you guys. And again, thank you everyone for joining, and we'll speak with you soon.
Yeah, thank you everyone for joining, and I appreciate all the interest, and thank you for the questions.